What is the demand now, the appetite to hedge?
So interestingly, to start the year, we haven't actually seen much a significant increase in demand for hedges up until I would say over the past week, and that's interesting because obviously we had a 10% pullback in the S&P in January, and actually volatility really underperformed on that sell-off because of this lack of hedges, and I would say part of that reason is because you think of the catalyst driving that correction, it was fear of higher rates, and that's really a well-anticipated catalyst. It's not really an unknown or an uncertain, unexpected risk. What we're seeing over the past couple of days is more demand for hedges on the back of the Russia-Ukraine news, and also on the back of a speculation that the Fed may be hiking intermeeting. I think that has driven a lot more hedging activity in recent days.
What is the leverage exposure wrapped around the hedges and, frankly, the entire market? I mean, frankly, folks, Credit Suisse literally invented the monitoring of leverage, I would suggest. What is the depth of leverage out there?
So I think for a lot of institutional investors, they have deleveraged quite a bit. Especially January was very painful for a lot of hedge funds, and this is, I would say, the most pronounced at the sector level for tech. In terms of kind of the protection buying that we're seeing, they're not crash protection buying. Typically, the protection buying that we are seeing is positioning for a more modest pullback from here. So I would say, given what happened in January, given the deleveraging that we have already seen, the protection buying that we're seeing right now, it's more modest. It's not as bearish as some might think.
Mandy, a lot of people will think of me as the person who comes up with a negative scenario no matter what happens. But there is that kind of baked into the hedges too. There are the people who are hedging for a Fed policy error on both sides, not only moving too fast, but not moving quickly enough at a time when inflation itself is crimping demand, or there is the fear of that. Perhaps we'll see some of that in the retail sales at 8:30. What's your view on why people are hedging and how you can determine this from the type of hedge?
Sure. So I would say, on the risk of the Fed being behind the curve, I would say that's a risk that is, I think, overblown, because yes, we're seeing very high inflation right now, but the important thing to emphasize is that long-term inflation expectations, whether or not you're looking at market-based expectations, looking, for example, at the five-year forward break even, or you're looking at consumer surveys, they remain remarkably well anchored, and as long as that remains the case, I do think the Fed has more breathing room. But in terms of what people are hedging, I would say looking at hedges in tech has been very popular, and then the second one that has been more popular right now is looking at cross-asset hedges. Given some of the moves in equities that we have seen, people looking across other asset classes, for example, fixed income ETFs, precious metals like gold, for example, that's been another popular one.
Mandy, have you seen a lot of investors decide to shift around their allocations with hedges, with derivatives, rather than actually selling some of those holdings? And I think about tech stocks. For a long time, people were worried about getting rid of them for fear of not being able to buy them back at an appropriate price later.
Yeah, I don't think that fear is as dominant this time regarding tech. But in terms of kind of how people are hedging and what they're doing, particularly I would say on the risk of inflation, it's very notable that what we've seen is in high inflation regimes, the correlation between equities and bonds break down, right? That's an empirical fact. And that's obviously not good if you're a multi-asset portfolio, say a 60-40 traditional fixed income equity portfolio, because your bonds are no longer diversifying your equity risk. So what we have seen from a lot of institutional investors is a look at more equity specific hedges, so less reliance on fixed income to be your hedge. And the second thing is looking at commodities, right? Adding a commodities allocation, because obviously commodities a big driver of the current inflation that we're seeing, and historically always been that case. So looking at either adding allocation to the underlying commodity or increasing upside exposure to some of the commodity sensitive sectors, for example, energy.